Hey guys, um, today I'm going to continue, with where we stopped. I'm going to continue with types of pullback. That's what I'm going to talk about today. Um, so in pullback strategy, you have four main types of pullbacks. That is, four main ways in which the trade can unfold. So the first one is simple pullback. Yeah, simple pullback is essentially when I will show you what it looks like in a chart. So it's essentially when you get you got a couple of strong candles going up, you get a strong move in a particular direction, you get a strong move, then all of a sudden the move starts to stall, start getting small candles, the market will kind of start to roll over, forms a small flag, price will form a small flag, nice and clean flag, then you get a strong bullish push. Yeah. So this is a simple pullback. Price goes up, forms a clean flag, then continues to go back up. So this is a simple pullback. And of course, ideally, the second leg will be a strong push with momentum. So this is what a simple pullback looks like. Yeah. So the next type of pullback is a complex pullback. So a complex pullback is basically when you get a simple pullback and a lot of people get sucked in thinking that price will go up, flag, and will continue to move up. But what actually end up happening, this candle here, instead of continuing up, will close like this. You see? And most likely the next candle will continue heading down. So this is a complex pullback. So we've gone from having a simple pullback to adding more legs to the move. Yeah. If you go to a lower time frame, this will look like a mini trend, like a small trend. So on a lower time frame, it will probably look like price kind of pulled back like this, rallied a little bit, rallied a little bit like this, and continue heading down. So if you go down on a small time frame, this sequence of move right here, customize, eclipse, insert, close. So this sequence of move right here will be presented in this way in a smaller time frame. So it's like a small trend. See? So how do you handle this? I mean, when you have a simple pullback, the what you need to do is quite simple. You get the pullback, candle starts to move up, you take a buy, hoping that you will get this. The next couple of candles will continue to go up. But how do you deal with having this scenario? A simple pullback turns into a complex pullback. Then the thing is, when you are trading pullback strategy, you will notice that most a good proportion of simple pullbacks fail. So what you do in that situation is when you are trying to enter a simple pullback, you have to factor in that there are some probabilities that it will turn into a complex pullback. So when you trade this, instead of having your stop loss directly below here, you can account for this type of scenario happening. Yeah. So you can, what you can do is you reduce your leverage and widen your stop. So instead of having your stop somewhere here, you can have your stop somewhere here to account for this scenario. See? So what happens is if you get this scenario in a complex pullback, what you have to do is this is one of the most profitable and reliable strategies actually. I've looked into this a lot. So if you get a complex pullback like this, what you can do if this is 1 hour chart, you go down to a smaller time frame like 15 minutes chart. And once you form this and price starts to come down again, here's what you do. Price starts to come down and most likely price will start to weaken, buyers will start to step in, buyers will start to step in, it starts to go up, and we go down again. What you are looking for is when we are doing this, it will keep looking like this on the 1 hour chart. You have a candle that runs up like this, a green candle, then you have another red candle. This is like 1 hour chart, this would be like 15 minutes chart. So what you do is you have to wait for this zone to be taken out, like this high right here. Uh, you have to wait for this high to be taken out. Let me use. You have to wait for this high to be taken out. This is what you have to do. You wait for a candle to come up, take out this high. Then this is a like really really high probability trade. Once this thing happens on the 15 minutes chart, you can enter this trade straight away if you want to, or you can wait for the next candle to retrace just a little bit, then you enter the trade going in the original direction of the 1 hour of the like on the 1 hour chart it will look like this. A new candle will form breaking the high of this consolidation right here. Then you enter a trade and take it to the moon. So this is how you trade a complex pullback. And the thing is, once this thing happens on a lower time frame, man, maybe 90% of the time, if you put your stop loss here, once this high have been taken out, if you put your stop loss here, it will be pretty safe. Put your stop loss here, take buys here, or maybe wait for a small retracement, then take it all the way up. So this is complex pullback. Then another type of pullback is pullback to a support or resistance level. It's pretty simple. Yeah. Looking on the chart, this is a perfect example. Market rallied, pulled back, rallied, pulled back, rallied, pulled back all the way to the support here, all the way to this support, see, and start to go up. Where we are now is an example of a pullback to a support or resistance level. You see how we pushed down, came back up, now we are testing the support. So if you are trading that strategy, this is a good place to be taking shorts. So that one is quite straightforward. You take your shots here, probably your stop loss somewhere here, targeting maybe somewhere here. And we have a pullback to a Fibonacci level. This is one of my favorites actually. For a long time, I didn't really take these Fibonacci levels seriously. I mean, I'm not saying that it's a magic number, yeah, but through my statistical work, market seems to have a particular tendency. It doesn't even have to be the exact numbers you have on the Fibonacci original Fibonacci. But just knowing that when a market makes a move in a particular direction, there are certain you have. I mean, market have a tendencies to retrace to certain levels. Yeah, like where did I do the work? I have an analysis I did in Excel. I did some work in Excel. Where is it? Found US 60 minutes. So the thing is, price have a tendency not to move in a straight line. When we push up, we have to retrace a certain amount before we continue to go up. Yeah. And through my work, if price push up from here to here, yeah, most of the time you are looking for a retracement that is not more than half of the original move. Yeah, like 50% retracement. Once we retrace more than 50%, the probability of price continuing higher is quite low. Yeah. So I mean, I've done the work. I'm waiting for this thing to open. So any retracement below 50%, above 50% retracement. So if we have this move right here, so you don't really want 50% is right here. The line. So this is 50% where I will put this line, the red line. So you don't really want price to retrace too much past those level. Yeah, because when they retrace more than that, the chances of price coming back up to test this high at least is quite slim. So you want to see a strong push, and you want to see markets holding the price above at least 50% of the initial push. Okay, so here is the work I've done on that. Um, so you can see. So when we have a strong push in a particular direction, so this is a bull flag, yeah. Clear filter, a bull flag. You can see. So these are the retracement levels. So you can see zero, less than zero, 0 to 10, 10 to 20, 20 to 30, 30 to 40, 40 to 50, 50 to 60, and so on. So you can see that most of the retracements are between 40 and 50% retracement level. Yeah. And what's interesting is that I was looking at here on the analysis somewhere here. I was looking at the size of the retracement compared to how often the next candle will close positive. Yeah. So if we have a strong push, depending on how far the next candle retraces down, will tell a lot on whether it will close positive or not. So here, when we have a retracement that is less than or equal to 60%, yeah, it happens about 64% of the time. Number of positive closes, 63%. Number of negative closes, 37%. Yeah. If we have a retracement that is less than 50%, yeah, so it happens about half the time. Then number of positive closes is 68%. You see, this is 64% when it's less than 60, up to 60. But if it's up to 50, then chances of the next candle closing positive goes up to 68%. Yeah. And number of negative closes when we have this much retracement is around 32%. But what if the bull flag, the level of retracement is less than or equal to 25%? It happens about 16% of the time. But when this happens, number of positive closes, the probability of the subsequent candle closing positive is around 87%, and the probability of the subsequent candle closing negative is something like 13%. Yeah. So I will show you what happens when we have a retracement of greater than 60%. It happens about 36% of the time. Number of positive closes goes to 17%. So when we retrace more than 60%, have more than 60% retracement. Yeah. So number of positive closes is about 17%, and number of negative closes goes to 83%. So you get the idea. So the point is, if you get a strong push and we pull back, the shallow, the more shallow the retracement, the better. The shallower the retracement, the better. So this is how I use. So when I'm trading with Fibonacci, when I put the Fibonacci up, yeah, I'm pretty much gauging the strength of the retracements. Yeah, if price retraces this much and I take a buy around 50% level, and it goes down to maybe 60%. In this situation, I'm not looking to make profit in this trade anymore. Yeah. All I'm looking for is to price come back to where I got in, maybe to scratch the trade at break even. Because I know through my work that once we break that 60% level, you know, my my the advantages I have going into the trades are gone. You know? So there is no point in hanging around and hoping to salvage something out of the whole situation. So I play for defense. Let me put it that way. And that is yeah, that sums up pullback to the Fibonacci level, and that's how I use it. On the next slide. So when we trade pullback, how exactly are we making money? How exactly are we making money? Another thing that I forgot to talk about is another type of pullback strategy. It's similar to what I've described using individual candles, but if you don't want to scalp and you want to you want to be more consistent, let me put it this way. Yeah. What you do actually is to so if you look at the chart, so this is a 50 period EMA, and these envelopes, 50 period envelopes plotted. I think the standard deviation is about 10, 0.10. The point is, you never want to be taking buys or sells anywhere outside of this value zone. I call this area value zone. Yeah. And the idea is, if the envelope is sloping upwards, you are only hunting for buys around the envelope. But the key to this particular type of trading, this type of pullback, is we are using very little or no leverage. Yeah, little or no leverage. Oh, happy new year. It's a new year. You can hear the fireworks going off. Okay, so let's keep going. So it's 2022, 1st of January 2022, a new year. Yeah, so if you're trading this type of strategy, so essentially what you do is you cut your leverage in half and use wider stops. So you are getting into trade somewhere here, and your stop loss are below the lower band. Yeah, taking trade somewhere here, your stop loss are here. But the thing is, very rarely will the stops get hit. Yeah, but what you will be doing, or what I do, is if I take a trade and it goes against me, yeah, 50% and this lower band is like once we start venturing out of here, somewhere here, definitely I'm wrong. Yeah. So in this situation, I'm not looking to make profit anymore. So I'm hoping for, not hope, but what I'm looking for from here on is one of the two things can happen. Price can just barrel down, straight down, and take me out. It happens every once in a while, but most of the time, what will happen is I take buys here, price will come down, then we get a green candle like this, a retracement like this. Once you retrace and got into close to somewhere here, I scratch the trade for a small loss. I'm not looking to make profit. I'm not looking to break even. Just get out at a smaller loss. Yeah. So this is another way to trade pullback. But every now and then, you might not get the opportunity to get out at a smaller loss. So market will just go down and just drop like a rock and take you out. But this is extremely profitable. Extremely profitable. But you can't do this with leverage. It has to be either maximum 2 to 1 leverage. Maximum. Maximum 2 to 1 leverage. So this is another way of trading pullback. So let's go to how are we making money? How exactly are we making money? So if you trade pullback, your win rate will be something like 70% if you do it right. Yeah, I have to get some water. Yeah, so the win rate is about 70%. Yeah. So when you trade pullback, yeah, remember that in my previous videos, I showed you guys what a pullback looks like in a bigger time frame and what it looks like in a smaller time frame. So basically, when candles are making higher highs and higher lows, let's say here, this movement here, I mean, on a higher time frame, it will seem like these are just a series of candles going higher and higher. But if you go to a smaller time frame, it will be a series of up moves, pullback, up moves, pullback, up moves, pullback. So how are we making money? If you have a big red candle, whenever you have a big red candle, yeah. So let me do this. So if you get a big red candle on a daily chart, so if this is a daily candle, yeah, it could it could look like something like this on the hourly chart, yeah. I mean, so you don't get confused, but it could, the path price took for a whole 24 hours to close like this could have been something like we opened here, came down, pulled back, came down, and closed down here, and it looks something like this. It looks something like this on a daily chart. But on a 1 hour chart, it's a clear downtrend. Yeah, on a 1 hour chart, it's a clear price moving up, moving down, eventually it goes down. But on a daily chart, it looks like one solid, big solid candle. Yeah. So the thing is, how are we making money? When you get a big candle like this on a daily chart, when the next candle opens, when the next candle opens like this, I will move this to an empty place. So So you get how we are making money. So when we get a huge red candle like this, yeah, already we know that it's a strong push down. So most likely on the hourly chart, it's a strong down move there. So when next candle opens, yeah. So these are the statistics. When the next candle opens here, it's like this. We don't even know what will happen. It opens like this. Yeah. From my work, the probability of this next candle opening here and taking out this high is something like 9 or 10%. So 90% of the time, this high is not gonna get hit. The probability of this candle hitting this low range of this candle right here, the probability of the candle opening and coming down at least here is something like at least 75%. 75% of the time, this low will be hit. Then there is a 30% probability that this candle is not going to hit the high or it's not going to hit the low. It happens about 20 to 30% of the time. So this candle might end up closing like this, closing like this as a green candle. Man, the, um, the fireworks is really loud. So it might close like this, end up closing like this. Yeah. This happens something like 20 to 30% of the time. Yeah. And the probability that this candle is going to open, break this low, then push back up and break this high is like it happens maybe 3 to 4% of the time. Yeah. So with this in mind, how are we making money? How exactly are we making money? Okay. How we gonna make money is that the range of this whole candle, imagine is 100%. Yeah. 75% this will be hit, something like 10% this will be hit. Yeah. And something like another 20%, this candle is not gonna go anywhere. If it closes green like this, we have a small loss. So if this high is hit, we take a full loss because since 10% of the time it's hit, that's where we put our stop loss. Yeah. So 10% of the time we will be taking full stop, we will be taking full loss. Around 20 to 20% of the time, we take a small loss, maybe like this, maybe like this. Candle closes like this, maybe it closes like this. Maybe it's a red candle, it closes like this. Open here just for a small profit, but this high was never hit. So how we gonna make money is that we will use Fibonacci level. So we started here, ended up here. Yeah. If the probability of this candle opening here and hitting here is 75%. Yeah. So if we can take a trade, remember the whole range of the candle is 100. Yeah. This is 0 to 100. So if we can get a trade anywhere above 25% retracement, we are making money because the expected value. Okay, if you add the spread, okay, let's say the spread covers about 5% of the range. Okay, let's say anywhere above 30% retracement, we are making money. Because if we are taking sales at, let's say, 30% retracement, so at 30% retracement, we're gonna make 30 points heading down, and when we lose, we are losing 70 points. Yeah, and our edge is 75%. Yeah, and you have to know we are winning. This is gonna be hit 75% of the time. A bunch of the other time, we are not really losing the whole 70 points. We are losing something in between. Only 10% of the time we're gonna be taking a full loss. So if you think of it, man, the expected value is something like 10.70. We win something like that. Okay, let me how I trade this is I try to get in at least 38% retracement, 38 to 50% retracement. Yeah. So let's call it 40% retracement. So 75% of the time I win 40 points. I said 0.75. I win 40. So what I'm calculating is the expected value. Yeah. Okay. Then when I lose, 10% of the time, I will take a full loss. Yeah. Okay. Minus 10% of the time, 0.10, I will lose 70. I will lose seven. No. If I'm buying at 40% retracement, so something like 10% of the time, I will lose 60. 10% times 60. Okay. Then let's say in the middle, when price didn't hit either end, happens 20% of the time. Okay, let's say that the majority of them are losses, small losses. So we are talking of 20% of the time. I lose something like, because if we are entering, if most of them end up somewhere here, okay, let's say that most of them are something like 25 points. Yeah. So minus 20% of the time, 0.20, we lose something like 20 points times 20. Okay. So the expected value of this trade is 4 points. We are making, or is it four? Oh, expected value of this trade is 20 points. Sorry. So every time we take this trade, we are making 20 points. So 75% of the time, we win 40 points. 10% of the time, we lose 60 points. And 20% of the time, we lose something like 20 points. So the expected value of this trade is we are making roughly about 20 points a trade. So that's how we're making money. Of course, my calculation is not precise, because sometimes here I win also. It's not always small losses. But even assuming that the 20% of the time we are losing entirely. We never take even not even a small win. You can see that it's profitable. That's how we're making money in this strategy. Yeah. So these are why it works. These are why it works. Another thing that gives us an edge why this strategy works is that I've done some work relating to uh is there an edge, because I've always have this intuition that the largest price move seems to happen on the side of the moving average. I've noticed this a lot. Like it's a pain taking trade against on the opposite side of the moving average. And what I'm talking about is if price is above the moving average and you take short, most of the time it's really painful. And it seems like the more price goes against you, the faster they go. Yeah. And I've always had this intuition. Then I decided to do some work in Excel. And this is the result of that analysis. Did I do it in pound yen? I think I did it in pound yen. Is it pound, either pound yen or pound Australian dollar? So we are making money based on our win rate and how much we win when we win and how much we lose when we lose. Yeah. So our win rate is 70 to 75%. Our risk reward is we are risking something like 60 points or 65 points to make 40 to make 30 to 35 points on most trades. Yeah. So basically, any risk reward, if we are risking 1%, if we are risking 2% to make 1%, anything better than this, anything better like greater than or equal to 1 on this side of this equation is better for us because our on our side we have 75%, 70 to 75% edge. Yeah. So to break even on this side we need something like 30, on this side we need 70, and it's a break even. So anything bigger than 30 on this side we are making money. So if we are entering trade at 35% retracement, 38% retracement, 40% or 50% retracement, we are making money. Okay, let me show you the work I did on the moving averages. So EMA edge. Yeah. So I had a simple question. Is there an edge taking trades on the side of the moving average? So that was the question. So I calculated 20 period EMA, 50, 100, 200, and 480 EMAs. Yeah, and this is the EMA edge. So the question is, if price not just crossed the EMA, but if we have a candle that opens and closes above the EMAs, the simple exponential moving, it doesn't even matter what moving average anywhere. But in my case, I used the exponential moving average. If we have a candle open and close above the moving average and we only take buys, yeah, or if we have a candle that opens and closes below here and we only take sells, so what happens? Is there an edge to doing this? And this is my findings. So open, close, yeah, and these are the size of the candles. So these are the size of the candles. You know how if you buy on the open and close the trade at close, so these are what you're expected to make. Okay, so this is the 20 period moving average. So this is price above 20 period moving average, price below 20 period moving average. Yeah. So when price is above 20 period moving average, if price is above 20 period moving average, yeah, the average close, the average size of the candles are 13 pips. Yeah. And the average size of the negative of the average size of bullish candles are 13 pips, and average size of the bearish candles are 10 pips. So this straight away tells me that maybe there is something here. And the number of times when we are above 20 period moving average that you get a bullish close is 55%. And the number of times when we get a bearish close is something like 43%. And I looked at price below the 20 period moving average. You see size of the positive close, average size of the bullish candle is 11 pips, and average size of the bearish candle is like 15 pips. So you see, if the simple idea is it pays to trade with the trend, you know, if price is above the moving average, you get bigger, stronger pushes. Yeah. So you can see the the probability of getting a red candle when we are below 20 period moving average is like 55%. It's like the mirror opposite. Here is 55%, 55%, here is 43%, Here, the bullish candle is 45%. And I did this for 50 period EMA. For 50 period EMA is like 46.52 and 53.46. So the thing is, the strategy, even if you don't know anything else, just taking buys above here and never taking sells, and taking sells below here and never taking buys. This has to show you profit. Guys, you have to know that in the casino, yeah, roulette wheels have something like a 2% edge, and games like blackjack have maybe 2.5% edge. And this is showing you that you have almost what, 46, 56, then so almost a 7% edge trading on one side. It's insane. I mean, to do something else. To do something else is literally insane. And if you look at a chart, man, just watch how price move when we are below this line. Yeah, if you are taking buys, yeah, you have a couple of candles that works in your favor, but it's painful. But you see how easily the shorts flow. If you're on the short side, how easily it flows. So yeah, I've done the statistical work to back that up. So it comes down to the issue of how are we making money. We are making money trading on the side of the strong candle closes, like higher time frame candle closes. You have a statistical edge, yeah, because when we have a solid higher time frame candle close and a candle opens, you have a candle opens on the side. When that candle opens, yeah, if this low have not been tested, it's very dangerous to try to, maybe looking on a lower time frame and price is going up, to try to take bullish signals. Yeah, because this bullish signal, we already know that 75% this zone will be hit. Yeah. And if this is not hit yet, that probability is still there. So if you get maybe a positive, if your trading system gives you an entry signal to go long, you know that 7.5 is almost 8 times out of 10 times this will be hit. So if a candle opens and it's going up, most of the time it's just going up to as a retreat, like a retracement, retrace a little bit, to go down, which is the pullback we trade. When we trade pullback, you have a strong push, price retraces. So this is the retracement. Price is just doing the retracement, so it can continue going down. Yeah. So that's the thing. We get our edge by trading on the side of the higher time frame candle closes. If a higher time frame candle closes bearish, we are never going long. We look for an opportunity to take it down to at least test this low, or even continue going down like this. So this is one way we get our edge. The next one is trading on the side of the moving averages, only taking buys above here and only taking sells below here. So when we are above here, we're looking for pullbacks into here, pullbacks into here. We take a pullback into here and it doesn't go our way, it breaks down. Remember, our stop is always below these envelopes. It breaks down on us. What we are looking for, a retracement of some kind to scratch the trade for a small loss. So this is what we're doing. Okay. And another thing that I'm going to talk about is, another thing I'm going to talk about in terms of how are we making money. So it relates to candle ranges and how it affects entry and risk reward. Yeah, candle ranges. This is a very important concept. Yeah. So if we have a strong bearish candle, yeah, this is interesting, and you have a new candle that opens, the probability of this candle going down and ending up closing negative is something like 45%.
Yeah, it's crazy. So this candle, the probability that it will break this low is 75%. But the probability that it will break this low and close negative and close bearish like this, a bearish candle, is something like maybe 45 or 47%. Yeah. But the thing is, once this candle breaks this low, the probability the probability goes even up that it will close negative. Maybe it goes to something like, let's say if this candle makes it and breaks this zone, it goes up, the probability goes up slightly that it will end up closing positive. But the thing is, if you wait for this candle to break this low to increase your probability of being right, yeah, what have happened is that if you are taking this trade here, once we break this here, knowing that statistically the chances of this candle closing positive is not higher, yeah, let's say maybe from 45% it goes to 60% probability. What happens is that I want to talk about is candle ranges and how it affects risk reward. If you're entering this trade right here, once we break, man, remember our stop loss is here. So what this does is, already, if you entered here, your stop loss is, if you entered if you entered the trade here and put your stop loss here, is like 53 pips. But if you wait for the break of the high to give you more probability, and you are entering here, now you are paying almost 70 pips, 20 pips more to get that more certainty. So you have to ask yourself, yeah, what I talked about candle ranges. In every single time frame, every candle have an expected range. A range it is expected to move. On a daily chart, maybe the expected range might, for this particular pair, pound Swiss franc, might be between 90 and 120 pips. Say on average 100 pips. This is the expected daily range. If you go to the hourly chart, the expected daily candle range might be something like 13 pips or 15 pips. Yeah. Why this is important is, if a candle opens here and you are waiting for a break of this high, man, once we break this high, maybe this candle have already done 60% of the expected range. So once you enter the trade, if we've done 60%, maybe the only juice this candle have left to go. So you are entering here, maybe to get the 100% of the expected candle range, it might go only up to here. So this candle, you enter in here plus spread. By the time it gets here, man, you're out of juice. The candle, you've squeezed everything out of the candle. So what happens is that it screws with your risk reward really, really bad. So if you are taking trade here, this is the expected range of the candle. Yeah, 14 pips, but now you are taking a risk of 70 pips to make only 14 pips. Yeah. So you can take maybe 5 trades, and one losing trade just wipes out the whole game. So this is what I mean by candle ranges and how it affects risk reward. So how can we deal with this? How can we deal with this? So I've had time to think about this for a long time, and and what I came up with, what I came up with is that the majority of the time, instead of instead of looking for more certainty, we look for a way to reduce risk. Yeah. So most of the time when a candle opens, yeah, I will say 70 to 80% of the time, the candle will at least retrace something like 5 pips. or in terms of percentages, in terms of percentages, where did I do the work? Retracements. So you can see that when a candle opens, yeah, let's say 97% of the time, it will retrace at least 10 pips, yeah. Then something like 89% of the time. Okay, let me put it this way. 8% of the time you will get at least 10 to 20 pips retracement. And let's say 13% of the time. So look at this, where the bulk of the percentages lie. Yeah. So we are talking about between here and here. So a good chunk of the time, let's say you will get at least 40% retracement, most 30 to 40% retracement, at least. You will get this on 89% of the trades. So what you do is, or what we do is, when this candle opens, we're not gonna take a trade straight away. We already know through our work that this candle is going to retrace at least 30 to 40% of the time. So 38% retracement is somewhere here, which is close to 40. We know most of the time it will retrace at least 35 to 40%. So 35 is here, 40 is somewhere here. So when this candle opens, we wait for it to pull back a little bit. And once it pulls back, then we start selling if we are bearish. So what happens if we are taking sales here? Our risk is, instead of risking 70%, we are risking 34, 35 pips. Instead of risking 70 pips, we are risking 34, 35 pips. Yeah. And it increases our reward. So we are making 31 pips and we are risking something like 35 pips. So even if we didn't pull up to this much, let's say we retraced only up to here, which is about 38%, and that's fine too. If we are taking sales here, we are risking something like 40 pips. If we are targeting this low, we are getting 25, 26 pips. So remember our equation, the calculation we did. Yeah, for us to make money, we need to be risking something like 35 pips and risking something like we need to anything above 30 pips is good because our probability is still 75%. So if we are risking 26 pips, if we are risking 40 pips to make 26, that's extremely good. So because the total is 40, 26 is 66. So for us, 26 divided by, so if you say 40 plus 26, if you say 40, which is 66, plus 26 is 66, yeah? Okay. So if we say 26 divided by 66, so you see, we are making 39 points roughly. I mean, for us to break even, we should be making 30, 0.30. Anything above 0.30 is profitable for us. So 0.39 is excellent. So this is where our edge comes from. This is how we're making money. So 75% of the time we're winning this. We're winning 0.39, and something like maybe 10% of the time we take a full loss of 61, 0.61. Yeah. And something like 20% of the time we are taking a loss that is in between. Maybe it's not going to be 39, it's not going to be 61, maybe somewhere in between. So it's quite profitable for us. So anyway, this is that's the idea behind candle ranges and how it affects risk reward. So you never want to. The thing is, you never want to be taking trades once price have already started moving, because once you have a candle here, we may have exhausted the range already, and hardly in a given time frame you get a candle that goes way outside of the normal expected range. So that's why once we move, you never want to be taking trades, because most likely you're gonna get a pullback, yeah, and you're going to draw down. So yeah, the next thing we're going to talk about is the supply and demand, or support and resistance zone. They are all the same thing. Yeah. So essentially, what are these zones? So market, any market in the world, yeah, is governed by how the players perceive value. It's as simple as that. Yeah. For markets to take place, you have to have a disagreement in value and agreement on price. Yeah. Think about any market. If the price of a laptop goes down low enough, where a bunch of people perceive, man, this is a huge bargain, a bunch of people will go in, bought up the laptop at that low price. Yeah, they will keep buying it until you run out of supply, and price will shoot up again. Yeah, it goes up to a certain level where people who are buying laptop would decide, no, 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 this is too high. Nobody wants to buy it up there, then price have to come down for you to find willing buyers. That's just how market moves. Yeah. So when you look at a chart, yeah, you are looking at lower prices where people perceived value. If people perceive value at a certain area, chances are when market goes down to that area again, those that the people who thought that those levels were was a good price are gonna jump back in again. So, and this is the theory. The bottom line is, the turning points in charts are very, very important. So when you look at a chart from where you are looking at the next turning point above your current price, and the latest one below your current price. That's it. It's as simple as that. It shows you that price was up here, came down here, and people thought this was cheap. People with real money, and they came back in, pushed price up. Yeah, up here, people thought it was too high. They pushed it back down. We got down there. Those who bought here that thought it was cheap jumped back in, and they pushed price up. It's as simple as that. So you open up your chart, you map out your support and resistance zone. This is very, very important. And the thing is, you never want to be buying at resistance, and you never want to be selling at support. And you do this for your current time frame, your lower time frame, and most importantly, you do it at your higher time frame. Yeah, you always want to know where your support and resistance zones are on a higher time frame, and you never want to go against distance. If you're losing money consistently, this is probably one of the reasons. Yeah. So if you consistently selling look at this. Market pushed up, came down, price held, we pushed up again. When we came down here, those who thought this was a good bargain, they jumped back in and pushed price up again. Came back here, the same thing, push back up. So if we are coming down here and you are selling here, you're just gonna be banging your head against the wall. Yeah, because you are selling something that is already way too low. It's like the price of my laptop is have fallen to 100 from 500. Yeah, and the suppliers are saying, okay, no, we're selling for 100 now. It's gone down from 500 to 100, and you have your laptop, and you are even offering cheaper. Why would you keep selling here? It's already too low. Yeah, I mean, yeah. You want to be buying. You want to be buying at a support, and you want to be selling resistance, where people have already thought the price was too high, and they stopped buying. Price came up here, people thought it was too high. It was rejected. Look at the rejection. They rejected it. It came back down. Hit that zone again. Now you can see the price is struggling. So this is the simple idea. Just go to your higher time frame. You map out the support and resistance. Come back to your trading time frame and map out the lower ones. If we hit the higher support and resistance zones, you don't want to play with these things, guys. Always have to watch out for these things. So that's support and resistance in a nutshell. Yeah, and I've talked about how to identify it, how to map it out. So trade management, entry, stop loss, take profit, and scratching the trade. Putting on risk, reducing. So the thing is, entry. I've talked about entry. So when we have a strong push, if this is a higher time frame, what will this look like in a lower time frame? It's simple. So on a lower time frame, you see each grid represents what happened in a day, but this is a 1 hour chart. So from here to here is a daily chart. Yeah. So this is a bearish daily candle. This is a bearish daily candle. So I will switch to daily chart. Where is it? Yeah, see, where is it? Let's see what it looks like. So it's a bearish daily candle. This a bearish daily candle. You can see huge bearish daily candle. So even any of them, I have too many drawings. Anyway, it doesn't matter. The thing is, we have a bearish daily candle right here. Let's go to hourly chart. Go to hourly chart. Yeah. So you get a bearish day like this. Have a strong push downwards. So what do? So what am I talking about again? So entry, stop loss. Okay. So you have a bearish daily candle. Strong push. Yeah. Remember what we talked about here with this. So this will be the strong push. Or something like this. So this whole thing right here will be like this candle. That's what it looks like on the daily chart. And the next day opens, pulls back to this our buy or sell zone. Yeah. It will be that candle that opens here, pulls back, and that pullback, this is what it looks like. And this is where we want to be taking sales. Daily chart comes down, next candle opens, pulls back, then we are taking sales. Yeah, we take the sales, hoping that this level will be retested. Take our sales, come back, we close the trade, easy day. That's it, done. And that's pretty much what we are doing. Yeah. Another one, a pullback, taking sales. You're always taking sales here. When price is trending down, you never take them by hunting sales. Yeah. Of course, every now and then you will take a sell. You get a strong day. You take a sales here, it goes against you, and most likely your stop was here. But here we had an opportunity to manage the trade. When we entered the trade, let's say somewhere here, and it goes against us up to here. If we start coming down, came down, start pushing back up. Now we know market doesn't want to go down. When we start coming down again, we are trying to scratch the trade anywhere here just to limit our losses. We're not hoping to break even, or maybe for price to go down all the way here. Man, no, once we overshoot, we start coming down, we are looking to scratch the trade, a smaller loss. Yeah, before our stop loss got hit somewhere here. So that covers our entry. We enter in here, covers the trade management, how you manage the trade, and our stop loss is either on the previous day's high, or preferably we are using the upper band. You can see how rare it is that price is on one side and goes all the way to the other side. Every now and then it will happen. Yeah, every now and then it will happen. Like here, if we took buys here, somewhere here we got taken out here, but that's okay. This happens once in a while. Yeah, because if we are taking buys here, even if we get taken out, this is like 60 pips, 57 pips. With little to no leverage, it's okay, no problem. All we have to do is we keep taking trade and collecting when it works out. Taking trade, if it works out, we keep collecting. Here we take in trade, it works out. Here it doesn't work, overshoots, comes back a little bit, we scratch for a small loss. And this is what we do over and over. So yeah, so that's reducing risk, when trade is not working out. Yeah, we scratch, putting risk on. Putting risk on is knowing when to size up. This is a little bit of an advanced concept. It's a little bit advanced. When I'm trading pullback, yeah, I'm looking to size up when we have something like a complex pullback. A complex pullback is what I described before. When you have this structure, you have market come down, for example, it pulls back and a lot of people went short. What happens is when this thing happens, I will use an example I drew before. We are there. Yeah, so here. Okay, so this is a complex pullback. Yeah. So price came down. How do I do this? Okay, this is a complex. Okay, let me just use the arrows. Or maybe the thing is, you size up when you have a complex pullback. That's when you size up. That's when you put the risk on. So you have a pullback like this. Yeah, have a pullback. Price seems like it wants to go up, but it failed. This is going to be a green candle. It's a green candle showing a rally, but price kept going down. So this is what it will look like on a smaller time frame. On a smaller time frame, this mini trend here will look like this. Look like this. So we put risk on, man. If you get this, all you are hoping for is for this one of these highs to be taken out. The latest one, the latest high that made a lower low. Once we pull back, make a lower low, you're hoping for this to be taken out. Once this is taken out, yeah, and 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 price retrace, it kind of looks like this. Kind of looks like this. Maybe I should just remove some of the objects. Uh, delete all the objects. So the chart is clean and too many objects. Okay. So when you put risk on is we have price move up, come down as a simple pullback. Most likely people will start to take buy, and this is not going to continue. Then we have this. So this is a complex pullback. Once you go down to 15 minutes chart and we have this, so it's like a mini trend. A mini trend is developing on 15-minute chart, a short-term trend. When we have this, yeah. So what I'm hunting is for this high to be taken out, or if we haven't developed this one yet, for this one to be taken out, I'm looking for this to be taken out. So when these haven't happened yet, what I'm looking for is for this leg to come here. Take this thing out, then I'll be looking for a small pullback like this. As long as the pullback didn't break this low before I start seeing buying pressure, my buyer starts to step in, then this is where you can take, if you normally reach something like 1%, you can reach something like 1.5% or 2% on this trade. Once buyers start to step in and you can see buying pressure, yeah, you can take more than usual risk. I mean, not going full margin, but maybe if you are risking 1%, you can risk 1.5% or 2% on this type of trade. But if this didn't happen here and we continue to trend down, we go down a little bit. So once we've made a new low, then now we are looking at this high to be taken out. And we want a next leg to take this out. And we are looking for this. And we are hoping to, once we start seeing buying pressure stepping in, we are taking buys here, our stop losses here on this low, because this is why this is a high probability trade. We are hoping to take this and take it at least way beyond the initial high. Once you have a complex pullback, most of the time when it starts to work, it will go past this initial high. So this is where I put risk on, when I'm trading a complex pullback. So reducing risk, most of the time when we put trade on, yeah, I've shown it before. If we start breaking down here, coming back here, if we are long here, we break past here and start coming back, we are taking risk off straight away. Yeah. So that's how it goes. And the next thing I want to talk about is risk management. One thing I can say, I mean, most of you have probably heard people talking about risking 1%, risking 2%, and that's fine. That's fine. But for me, I found consistency in my trading, yeah, when I stopped using a lot of leverage. Most losing traders probably will turn their trading around if they massively reduce leverage and triple their stop loss. If you are used to using tight stop losses, you triple your stop loss. If normally you are using 20 pips stop loss, make it 60 pips. But instead of trading big position, then what you do is massively cut down your position. Yeah, and use wider stops. Man, with this, definitely you will be profitable. Most traders will become profitable. So for me, that's the best way to manage risk. And what happens, you see what I was talking about here? I mean, if you take buys here in this zone, if you took buy here and all of a sudden market start going against you here, man, when we are above this moving average, do you see how rare? Do you see how rarely price just goes down and touch this end? No. Even here, man, if you took buys somewhere here, yeah, price came all the way here, and you can see that this was not even hit. If your stop loss was here, it was not even hit. And you had the opportunity for price to reverse, come down here for you to close at a small loss or maybe even break even if you are lucky. Yeah. So this is what you can do when you are trading small size with no leverage, because it means you can take the hit. Yeah, you can take the hit. If you are trading, imagine if you are taking buys here with we took buys here with a small stop loss here. Man, do you know how many times you'll be stopped out? If you took buys here, your stop loss is here, your stop loss is here. Can you believe how many times you're just giving your money away? Look at this. Yeah. So cut your position size almost by a third, and increase your stop loss by a third. Yeah, this alone, and what this thing does, it gives you one, you are indifferent to the outcome of any trade. You don't care. You really don't care. And what will shock most people, you might think that you will not be able to make money. No, you still make money because you just keep collecting. Yeah, you just keep collecting. What I mean, you just keep collecting pips. You will be more consistent. So the thing is, if you do this, most of the time you take buys. If you take buys here, you have an opportunity to make a couple of pips most of the time. And if you keep piling them up, every once in a while, market will come down, take your stop loss. That's okay. You're not gonna lose much because you're not really leveraged up. But most of the time, the probability that I talked about before, the edge we have been on the side of the moving average and also trading the pullbacks. I talked about the probability we are working on when we trade pullbacks. Those two things will massively, massively, massively put the odds in our favor, no doubt. So that's my take on risk management and leverage. For me personally, most of my trades, I lose I lose about 1%, and most of my trades are way below 1% because even though my stop loss is 1%, I'm hardly ever taking a full loss. I hardly take a full loss. So it goes against me. Most of the time, you get the opportunity to get out before your stop loss is hit. Yeah. So trading psychology, man. One thing that happened to me, when I was losing money consistently, man, I hate losing. I mean, most people probably hate losing, but I have a sick feeling in my stomach when I lose. It's not even about it. It's not even because of the size of the loss, because I've never taken any loss that is too damaging. Yeah. But just a sick feeling of maybe my I put too much of my ego in the whole thing. Even I remember back in the day, even back testing, doing when I was doing the back test, just even to lose money in the back test, I used to almost feel like to will the price in the direction I want. That's how much I wanted to for things to work out in my favor. Even in the back test, I used to start doing back tests. I lose a couple of trades in a row, man. I feel sick to my stomach. I just shut the whole thing down and just go do something else. But the thing is, you have to get yourself to a place where you are almost indifferent to losses. And how I overcame my own, because listen, losing money never bothered me. In university, when I was in university, I traded poker. I pretty much traded poker played poker for a living. So losing money never bothered me. I mean, some days I have, mostly I have good days, but there are some days when you run so bad. What I mean by run so bad is that you can't seem to catch a break. You get your money in, the probabilities were in your favor. When the whole cards are dealt, somebody will catch a one outer, like like a scenario where you have to win 94% of the time, and this guy will catch one card on the river that will make him win the pot. Yeah, it's just one bad beat after another, man. If you're sick to your stomach, what can you do? Yeah. So losing money never bothered me, but it's just being wrong. It took me a long time to get over that thing, and I'm still working on it. It's not as strong anymore, but I used to almost try to will things to happen. Yeah. And over time, I kept backtesting. The more I played with the simulator, over time I just desensitized myself and started getting used to the idea of putting a trade on. and have it's not in, it doesn't go my way. Yeah, but it took a long time. So just what I can say, most psychological problems, you know, boils down to just backtest your strategy a lot. Whatever you are trying to do, spend so much time on simulator. And also try to do statistical work. We do statistical work on Excel. So I mean there is a difference between somebody telling you that something happens 70% of the time and taking the opposite action works 30% of the time. If somebody tells you this, sometimes you might still take that side of the 30% chance. If you do the work yourself and you analyze the result and you see what it is, man, it's like taking the negative side of the game is almost like drinking poison. I mean, you don't even need anybody to tell you this. It's just a no. It's like something you can't just do. It's a big no, a big no. So this is why it's important to do the work. You do the statistical work, you do the back testing. After you've done the statistical work, you have to still go to the simulator to see if the work you've done in Excel or whatever program you use, if it how it plays out in the real market using a simulator. You know, so this is important. And another good thing about doing statistical work is that poker is a lot more like trading, or trading is a lot more like poker. Yeah, and I'm a big poker fan. The thing with poker, man, you can start with a hand that have the highest probability of winning. Yeah, but as soon as the betting starts and new cards, the dealer start bringing in new cards, you can go from 90% probability of, I mean, 90% favor rate to a huge underdog once the flop comes and the turn comes and the river comes. So when you're playing poker, you are constantly adjusting. Your hand strengths become relative, and you are constantly adjusting to new information. So maybe when you started playing the hand, your hand strength was 90, but new information comes out that will make you reevaluate where you are, or how your hand ranks with whoever that is still in the hand with you. So new information comes in depending on the betting pattern, then you readjust, you reevaluate. The same thing with trading. We have this 70% edge or 75% edge that we're gonna hit the low of a momentum candle, of a big candle, or the high of a momentum candle. So these are the statistics. But of course, when the trade starts to unfold, depending on the price action, how price is behaving and what is unfolding in front of you, you can gauge when you still have that 70% or not. Yeah. So that's trading. But all these things will be learned by doing the work, backtesting, understanding when a particular setup is failing, yeah, and when it's likely to work out, and you keep adjusting your probabilities according to what is unfolding. It's like what I talked about, the level of pullback, the level of retracements. So if for example a move starts, let me go to an empty section of the thing. So let's take this area for example. Okay, so we have an empty space here. If we have a move, oh, this, if we have a move like this, if candle move up, if candle moves up like this, okay, we have a strong up move, okay, then it stops moving up. We have something like this. or something like this. Then price starts to roll over. So now we are entering into a pullback. So if we want to trade a pullback, we get our fib. For example, we put it here. We know that from our work that if this pullback terminates at, let's say, 50% level, 50 to 60% level, if it terminates anywhere here, as long as it's not more than 60%, let's say between here, yeah, if price have moved up, now we are pulling back. Anywhere above 50% still gives us the probability that the next candle, now this is, now guys, remember this is a lower time frame, so this is a lower time frame. On a higher time frame, this whole sequence will probably look like this. This is a one big candle. It's a one big candle like this. If let's say we don't have just a tiny wick at the bottom, so that's what the big time frame will look like. So what we are counting on is that we are, if this is the 50% zone, we are counting on, if the retracement terminates around 50%, then the probability that the next candle will open, if it terminates before the 50%, the probability that the next candle will open and close bullish like this is pretty high. It's higher than if this candle breaks the 50% retracement zone. Yeah. So from our statistical work, we know this. But trading real life, trading real, when this pullback is happening, so this candle have closed like this, a new candle opens and is starting to go down, as you can see. The thing is, we don't know where this pullback will end. But if a candle open here, our probability is still alive. Okay, we know there is a huge probability that this next candle, because we haven't broken the 50% level yet, there is a probability that this candle will most likely close positive. Remember that it's open here. So at this point, when we are coming down, the candle is red. Yeah. So now we are coming down. Coming down. Okay. So this is a small time frame. So this whole sequence, these two candles, is playing out in so many candles. So another candle opens here. So this is a 50% zone. So we still don't know. But because we haven't crossed it yet, we are constantly getting new information and you're updating your probabilities based on this new information. So this candle opens here. We still haven't crossed. Yeah. And if it stops here and the next candle comes up and starts closing like this, okay, our probability still says that once this candle finish, it will most likely close positive. So now we are starting to get something like this when we start pulling up. We have something like a wick right here. So this is what it looks like. And maybe the next candle might go all the way and close somewhere here. And this candle will look something like this. And this is it. But at every step of the way, when we are coming down, of course, when we haven't broken this, we don't know what the probabilities are. But if it's not broken yet, if we haven't broken this 50% level, we still know that we have a good probability that this candle will pull back here and go up and close positive. Okay, so here is another scenario. So what if what we have is this candle here came down all the way, go even up to 75% retracement. Yeah, it doesn't mean that this we can still get bullish candle closing here and this candle end up closing positive. It can still happen, but it's just that the probability goes down. It can happen, But yeah, it is what it is. So once we if we go down up to here, it doesn't mean that this can just come up and close positive. It's just that the probability is not there. So what we do and how we manage trade is once we retrace too much, goes down up to here, like something like this. We retrace too much. Now we are not playing for win anymore. Most likely we are hoping for, because we entered somewhere here, we are hoping for the next candle to open somewhere here, open somewhere here, come up. Once we get to our entry level, we are either taking something, we are taking risk off, either closing half of the position or even maybe closing 60% of the position, because most likely we know that most likely this candle is not gonna, I mean, go from here all the way, and or even a series of candle within our the expected time we are hoping for the trade to work out. It's not gonna do what we want it to do. So that's how we manage risk. Yeah, it ties down to what I was saying, that if you took a trade somewhere here, you take sell. If it goes past a certain point, this is not a good example, but like something here, if we came down here and pull back into this, we take sells, hoping for price to come back down here. If it overshoots, now we are not hoping to make money in this trade. We are hoping for some kind of retracement here, either to scratch for a small loss. That's the idea I was trying to explain here. So yeah, it's like trading, a game of new information. The more information that comes in, why the hand, why the game is in unfolding, then we are adjusting what we're gonna do. Yeah, we are adjusting what we're gonna do. So that's why I love this. I mean, trading so much. I mean, why it relates to poker so much and why it's so challenging. It's very challenging because you can. It's a game of probability, and new information keeps coming in, and you have to keep updating your probability. And it's not an easy thing to do, but it gets easier. The more you do your work and start to anticipate how things might unfold, and what you're gonna do about it. Anyway, guys, this wraps up, the host lectures on how to trade pullback. Okay, happy New Year's, happy 2022. Okay, talk to you guys maybe in my next series. Okay, bye.